Hello everyone, welcome to EPK Capital's deep dive video. In this series we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Philip Morris. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. The smoke-free paradox. What if one of the world's largest cigarette companies, the international home of Marlboro, was spending billions of dollars to make its own core product obsolete? This is not a hypothetical scenario, it is the reality of Philip Morris International. The company built a global empire on combustible tobacco, but today, it is staking its future on a radical transformation, a smoke-free world. This presents a central question for investors. Is this a genuine public health revolution that offers a unique investment opportunity? Or is it a masterful marketing pivot, designed to navigate a world that is turning against smoking, while masking old risks in new packaging? The answer lies within the numbers, the strategy, and the immense risks involved. In this deep dive analysis, the business and financials of Philip Morris International, stock ticker PM, will be dissected to provide a clear, unbiased view. The company and its architects from a London shop to a global behemoth. The origins of the Philip Morris name trace back to a single tobacco shop opened on London's Bond Street in 1847. Over the next century and a half, it evolved from this humble beginning into a global consumer goods behemoth. However, the modern iteration of Philip Morris International, PMI, was truly born in 2008 through a pivotal corporate action, its spin-off from the Altria Group. This separation was a profound strategic maneuver. At the time, Altria's U.S. tobacco business was entangled in a complex and costly legal environment, largely defined by the 1998 Tobacco Master Settlement Agreement and ongoing litigation. Altria's management concluded that the high-growth international operations were being undervalued by the market due to this litigation discount. The spin-off was designed to unlock the value of Philip Morris International by creating an independent, publicly traded entity focused exclusively on markets outside the United States. This move effectively insulated the international business from the legal and regulatory constraints of its domestic counterpart, Philip Morris USA, giving it the strategic and financial freedom to pursue a different path. A path that would lead directly to its current smoke-free transformation. BPMI's two-headed engine. The old world and the new today, Philip Morris International operates a dual-engine business model, balancing a profitable legacy segment with a high-growth, next-generation portfolio. The legacy business, combustibles. This segment is the historical cash cow of the company. It is built upon a portfolio of some of the world's most recognized cigarette brands, including the global icon Marlboro, alongside other major names like L&AMP, M, Chesterfield, and Parliament. While global cigarette shipment volumes are in a state of managed decline as smoking rates fall, this segment remains immensely profitable. 11 In fiscal year 2024, combustible products generated $23.2 billion in net revenue. The enduring brand loyalty and significant pricing power of these products allow PMI to generate substantial cash flow, which it uses to fund its transformation and reward shareholders. The growth engine, smoke-free products SFPs. This segment represents the declared future of Philip Morris International. The company has invested over $14 billion since 2008 to develop, scientifically substantiate, and commercialize a portfolio of what it terms reduced-risk products, RRPs. This portfolio is built on three main technology platforms. 1. Heated tobacco products, HTPs. This category is led by the flagship brand IQOS. Unlike a cigarette, which burns tobacco at high temperatures, IQOS heats specially designed tobacco sticks to generate a nicotine-containing vapor. The company's research indicates this process emits, on average, 95% lower levels of harmful chemicals compared to cigarette smoke. IQOS has been the primary driver of PMI's transformation, experiencing explosive growth in markets like Japan and Europe. In a landmark shift, the net revenue generated by IQOS surpassed that of the Marlboro brand at the end of 2023, signaling a major inflection point in the company's business mix. 2. Oral nicotine. This category is dominated by ZYN nicotine pouches, a small, spit-free pouch placed under the lip. Following the acquisition of Swedish Match in 2023, PMI became the owner of ZYN, the leading nicotine pouch brand in the United States. This acquisition provided PMI with a powerful second engine for smoke-free growth and a significant foothold in the US market. 3. E-Vapor. The company also competes in the vaping market with products like VEEV. PMI has set an ambitious target to derive more than 2/3 of its net revenues from these smoke-free products by the year 2030. As of mid-2025, smoke-free products already accounted for 41% of total net revenues, demonstrating tangible and rapid progress toward this goal. See the leadership and ownership structure. The monumental task of steering this transformation falls to a team of seasoned executives. The company is led by Chief Executive Officer Jacek Olczak and Chief Financial Officer Emmanuel Bebo, both of whom have extensive careers within PMI and the broader consumer goods industry. Their leadership is critical in navigating the complex operational, financial, and regulatory challenges of pivoting a business of this scale. Reflecting its status as a blue-chip global company, the ownership of Philip Morris International is dominated by large financial institutions. Over 80% of the company's stock is held by institutional investors. The largest shareholders are household names in the investment world, including the Vanguard Group, Capital World Investors, and BlackRock, indicating a high degree of confidence from the professional investment community in the company's financial stability and strategic direction. A decade in the financials. A deep dive into Philip Morris International's financial statements over the past decade reveals a company in transition, characterized by steady performance in its legacy business, rapid growth in its new ventures, and an unconventional balance sheet that requires careful interpretation. The big picture: revenue, profit, and margins. Over the 10-year period from 2015 to 2024, PMI's net revenues have shown consistent growth, increasing from $26.8 billion to $37.9 billion. This growth is not merely a function of inflation. It is the result of a carefully executed strategy where the company has leveraged its strong pricing power in the combustible segment to more than offset declining cigarette volumes, while simultaneously benefiting from the exponential revenue growth of its smoke-free products. Profitability has remained robust, though net income has been more volatile than revenue. Over the same period, net income has fluctuated, starting at $6.8 billion in 2015 and ending at $7 billion in 2024, with a peak of $9.7 billion in 2021.9. A key indicator of the business's underlying strength is its operating margin, which has consistently remained in the highly profitable 30% to 40% range, a testament to the powerful brand equity and efficient operations of the company. B. The balance sheet anomaly: high debt and negative equity. A cursory glance at PMI's balance sheet might raise alarms for an investor unfamiliar with its history. Total debt has increased significantly over the last decade, now standing at over $51 billion. Even more striking is that the company's total shareholder equity is, and has been for many years, negative, currently reported at approximately $10 billion. However, this negative equity is not a sign of financial distress or impending bankruptcy. It is the direct and intentional result of a long-standing capital allocation strategy focused on maximizing shareholder returns. For decades, PMI has engaged in aggressive share buyback programs and has consistently paid out a large portion of its earnings as dividends. This practice has resulted in the company returning more cash to its owners than it has generated in cumulative net income, a process that mathematically reduces the book value of equity on the balance sheet, eventually driving it into negative territory. Furthermore, accounting principles require assets to be recorded at historical cost and then depreciated, while the company's most valuable assets, its intangible brands like Marlboro, which are worth billions, are not fully reflected on the balance sheet. This creates a disconnect between the accounting book value and the true economic value of the enterprise. For a company like PMI, analyzing cash flow is a far more meaningful exercise than relying on traditional balance sheet metrics like book value. The Benjamin Graham Valuation Test to Introduction to the Father of Value Investing. Benjamin Graham, the author of The Intelligent Investor, is widely considered the father of value investing. His philosophy centered on the concept of a margin of safety, purchasing securities for significantly less than their intrinsic value to protect against unforeseen business problems or market volatility. He laid out a series of stringent qualitative and quantitative criteria to help defensive investors identify sound, conservatively financed companies trading at reasonable prices. BPMI's scorecard on Graham's 7 criteria applying Graham's strict quantitative rules to Philip Morris International reveals a significant disconnect between his traditional framework and the realities of a modern global company with PMI's financial structure. 1. Adequate size. Graham required a company to have substantial annual sales to ensure it was not a small, speculative venture. With annual net revenues exceeding $37 billion, PMI easily surpasses any modern, inflation-adjusted threshold for this criterion. 2. Strong financial condition. Graham used 2 key metrics to assess financial strength. Hollow circle current ratio. He stipulated that current assets should be at least twice current liabilities, a ratio of 2.0. PMI's current ratio is approximately 0.83, well below this conservative benchmark. Hollow circle debt versus net current assets. He also required that long-term debt should not exceed net current assets minus current liabilities. With over $42 billion in long-term debt and negative net current assets, PMI fails this test decisively. 3. Earnings stability. A defensive investment should have a long history of profitability. PMI has reported positive earnings in each of the last 10 years, demonstrating consistent profitability. 4. Dividend record. Graham valued a long, uninterrupted history of dividend payments as a sign of financial discipline and shareholder focus. Since its spin-off in 2008, PMI has paid and increased its dividend for 17 consecutive years. While this is shy of Graham's 20-year rule, the consistent growth demonstrates a strong commitment that aligns with the spirit of the criterion. 5. Earnings growth. To ensure the company was not stagnant, Graham looked for a minimum 1/3 increase in earnings per share, EPS, over the past 10 years. PMI's diluted EPS grew from $4.42 in 2015 to $4.52 in 2024, with a peak of $5.83 in 2021.24. This flat to modest growth over the decade does not meet the 33% threshold. 6. Moderate P/E ratio. Graham cautioned against overpaying for a stock, suggesting a price no more than 15 times the average earnings of the past 3 years. PMI's average diluted EPS from 2022-2024 was approximately $5.12. A 15x multiple on this average would imply a price of around $77. The company's stock currently trades at a significant premium to this level. 7. Moderate price-to-book (P/B) ratio. Finally, Graham suggested a price no more than 1.5 times book value. This is where the analysis for PMI completely breaks down. See why the Graham number is mathematically impossible for PMI. The Graham number is a formula that combines the P, E and P/B criteria to arrive at a theoretical intrinsic value for a defensive stock. The formula is Graham number equals 22.5 times EPS times BVPS. The problem is fundamental. Philip Morris International has a negative book value per share, BVPS, approximately $7.56 as of year-end 2024. It is mathematically impossible to take the square root of a negative number, rendering the Graham number formula completely unusable and invalid for valuing PMI. This is a direct consequence of the company's capital allocation policy of returning more cash to shareholders than it retains, as discussed previously. While PMI fails most of Graham's strict quantitative tests, it arguably embodies some of his more important qualitative principles. Graham sought businesses with a dominant competitive position, or an economic moat, that could generate predictable earnings for decades. PMI's portfolio of iconic brands and its global distribution network certainly fit this description. The failure of the quantitative tests highlights a limitation of applying industrial-era valuation metrics to a modern company whose greatest assets are intangible and whose financial strategy prioritizes cash returns over building book value. A modern investor applying Graham's principles might therefore look past the failed metrics and focus on the durability of the company's cash flow and its attractive dividend yield as their primary margin of safety. The bull versus bear debate. The investment case for Philip Morris International is one of the most polarized in the market. It hinges on one's view of the company's ability to execute its ambitious transformation while navigating a sea of external threats. The bull case. Why PM could soar. Pros. Filled circle dominant market position and AMP, pricing power. PMI's scale is a massive competitive advantage. The company holds the number 1 or number 2 market share position in many of the approximately 170 markets where its products are sold. The Marlboro brand remains a global icon, affording the company incredible pricing power. This allows it to raise cigarette prices to offset volume declines and protect profitability in its legacy business, providing the stable cash flow needed to fund its future. Filled circle first mover advantage in smoke-free products. With IQOS, PMI is not just a participant but the clear global leader in the heated tobacco category. It commands over 75% of the global market for heated tobacco units where it is present, giving it a substantial head start and scale advantage over competitors. This leadership position allows it to shape the category and capture a disproportionate share of smokers who are looking for alternatives. Filled circle explosive growth of ZYN. The acquisition of Swedish Match was a game-changing move that brought ZYN, the number 1 nicotine pouch in the lucrative US market, into PMI's portfolio. This provides a second, powerful, and distinct engine for smoke-free growth that is not dependent on the success of heated tobacco, diversifying its next-generation portfolio and giving it immediate, significant exposure to American consumers. Filled circle defensive business with strong shareholder returns. The tobacco industry is a classic consumer staple sector. Demand for nicotine products tends to be inelastic and resilient during economic downturns, providing a defensive quality to the company's earnings. This stability, combined with a consistent and growing dividend, makes the stock highly attractive for income-focused and risk-averse investors seeking reliable cash returns. Be the bear case. Why PM could stumble. Cons. Filled circle intense and unpredictable regulatory risk. This is the single greatest threat to the company. Governments worldwide are united in their efforts to reduce tobacco consumption and are constantly implementing stricter regulations. These include punitive excise tax increases, bans on flavors, such as the European Union's ban on characterizing flavors in heated tobacco, severe marketing restrictions, and the implementation of plain packaging laws. A single adverse regulatory change in a key market could materially impact revenue and profitability with little warning. Filled circle. The melting ice cube, the core combustible business, which still generates the majority of profits, is in a state of secular decline. Global smoking rates are falling, particularly in developed nations. While PMI has managed this decline skillfully so far, there is a risk that the rate of decline could accelerate, potentially happening faster than the smoke-free business can grow to replace the lost profits. This could lead to a painful period of contracting revenue and earnings. Filled circle ESG headwinds and SIN stock status. Environmental, social, and governance (ESG) considerations are increasingly important for investors. As a tobacco company, PMI faces significant headwinds. A growing number of institutional funds and retail investors have mandates that prohibit investment in the sector, which can limit the pool of potential buyers and depress the stock's valuation. Furthermore, the company's smoke-free messaging is under constant attack from public health groups and regulators, who view it as a disingenuous marketing tactic to re-normalize nicotine use. Filled circle execution and competition risk. The transition to smoke-free products is a complex and capital-intensive undertaking. There is no guarantee of success. Competition is intensifying, with rivals like British American Tobacco, with its Glo HTP, and Japan Tobacco, with Plume, investing heavily to capture market share. A misstep in product innovation, marketing, or supply chain management could cede ground to these determined competitors. The global regulatory gauntlet. The regulatory environment for tobacco and nicotine products is not static, it is a constantly tightening gauntlet. Filled circle taxation. Tobacco taxes are widely recognized by public health bodies like the World Health Organization as the most effective tool for reducing consumption. For PMI, this represents a constant threat to both volumes and profit margins, as governments can and do raise excise taxes frequently. Filled circle flavor bans. The recent move by the European Union to ban characterizing flavors in heated tobacco products is a critical development. It demonstrates that regulators are willing to extend restrictions, which were once confined to cigarettes, to the new smoke-free product categories. This creates significant uncertainty for the future of flavored ZYN and VEEV products in many markets. Filled circle marketing and advertising. Nearly all forms of traditional tobacco advertising are banned globally. PMI is now facing legal challenges that attack its core, smoke-free, messaging. A lawsuit in France, for example, alleges that the company's campaigns constitute a form of illegal propaganda designed to circumvent advertising laws. B. The litigation landscape. While the 2008 spin-off shielded PMI from the direct financial fallout of major U.S. lawsuits like the Master Settlement Agreement, the company is by no means immune to legal challenges. In fact, the litigation battleground is shifting to mirror the company's business transformation. Filled circle new legal fronts. A new wave of litigation is emerging that specifically targets the smoke-free portfolio. A prominent example is a lawsuit filed in May 2025 by the city of Baltimore against PMI and its subsidiary Swedish Match. The suit alleges that the marketing of ZYN nicotine pouches unlawfully targets children and adolescents, creating a new public health crisis. This represents a significant new legal front that could have broad implications if successful. Filled circle patent disputes. The smoke-free product space is a hotbed of innovation and, consequently, intellectual property disputes. In February 2024, PMI announced a global settlement with its chief rival, British American Tobacco, to resolve all ongoing patent infringement litigation related to their respective heated tobacco and vapor products. While this settlement removes a major uncertainty, its existence underscores the fierce competition and high technological stakes in the race to dominate the next generation of nicotine products. See the ESG dilemma. The ethical dimension of investing in Philip Morris International cannot be ignored. Filled circle. The ZYN stock label, the company's primary business activity, selling an addictive product that causes significant public health harm, is a fact that PMI itself acknowledges in its sustainability reports. Point 2. This places it firmly in the ZYN stock category for many investors, creating a permanent headwind for its valuation. Filled circle ESG ratings. Independent ESG rating agencies reflect this inherent conflict. Sustainalytics, for example, assigns PMI a medium risk ESG rating of 26.4. While the agency rates the company's management of ESG issues as strong, its fundamental exposure to these material risks is unavoidably high. This rating is better than some peers, like British American Tobacco, but still signals significant caution to ESG-conscious investors. Filled circle controversial transformation. The company's narrative of a smoke-free transformation is heavily contested. Public health organizations and anti-tobacco advocates argue that this is a public relations strategy designed to rehabilitate the company's image, re-normalize nicotine use for a new generation, secretly fund favorable scientific research, and ultimately ensure the long-term survival of its business by addicting new users to its alternative products. Conclusion and AMP. Disclaimer. Synthesizing the analysis. After a thorough examination of the financials, strategy, and risks, a clear picture of Philip Morris International emerges. This is a corporate giant in the midst of one of the most audacious and controversial transformations in modern business history. The analysis reveals a company that is filled circle financially powerful, with immense and reliable cash flow generation and an unwavering commitment to its dividend. Filled circle operating a dual business model where a declining but highly profitable legacy segment is funding a new, high-growth business in smoke-free alternatives. Filled circle a stock that defies traditional value metrics like the Graham number due to a unique capital structure, forcing investors to prioritize cash flow analysis over balance sheet book value. Filled circle facing a formidable and ever-present wall of regulatory, legal, and ethical challenges that directly threaten its future growth prospects. B. The core investment trade-off. Ultimately, an investment in Philip Morris International today is a bet on execution and a race against time. It is a belief that the powerful growth from IQOS and ZYN can outrun the inevitable decline of cigarettes, all while successfully navigating a hostile and unpredictable global regulatory environment. The trade-off is clear. An investor receives a high, consistently growing dividend and a stake in a potential high-growth transformation. In exchange, that investor must accept significant and often unpredictable headline, regulatory, and legal risk. See disclaimer. This analysis is for informational and educational purposes only. It does not constitute financial advice, nor is it a recommendation to buy or sell any security. Investing in individual stocks involves a significant degree of risk, including the potential loss of principal. All investors should conduct their own thorough due diligence and consult with a qualified financial advisor before making any investment decisions. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description.